our event co-organized by IIEP and Citi, especially at 8 o'clock on this beautiful morning. So, as you know, in 2015, countries around the world adopted 17 Sustainable Development Goals. A central challenge, however, in moving towards these goals is the fiscal constraints faced by governments across continents. So it's become very clear to people that there is an increasing need for private capital to be involved to foster the sustainable economic growth and development. Today, we are very pleased to have a panel of distinguished speakers from both public and private sectors, from academia and policy institutions, to discuss first the progress that has been made on financing SDGs, drawing from research that's been done in IIEP and Citi, and second, to discuss the next steps and strategies to expand the scale, the scope, and the synergies of SDG financing. Without further ado, I'd like to bring to the podium my co-organizer and partner of this event, Julie Monaco, Managing Director and Global Head of Public Sector Group from Citi.
Good morning, everybody. I just want to welcome everyone and thank you for taking the time to come and visit and to spend this 2 hours with us when everybody has such busy agendas. I think that one of the things that's very impactful is the fact that we're talking about financing SDGs and that has become the standard in the way everybody is talking about financing. And we've watched that evolve over the last couple of years. We've had multiple years of conversations around how to get more private sector money and how to deal with private sector partnerships. But I would say that over the last 18 to 24 months, we've seen almost crystallizing in a targeted way of how both the private sector and the public sector are talking off the same sheet of music about SDGs and how we're going to finance SDGs. We have from Citi, Peter Sullivan, who runs our Africa business, and we've been very happy to have this partnership with GW during the World Bank meetings to focus specifically on how to provide financing to Africa. And this is, I think, our third or fourth session that we're doing. And so the dialogue continues, and it's incredibly important. And we have a very strong group of panelists this morning that are going to talk to you about specifically around the SDGs, but also specifically focused on Africa. So I think that I want to just welcome you all to coming. We're really looking forward to the conversation. The other is that this is a small group on purpose. We want this to be interactive, and we really want this to be a dialogue. It's a dialogue that's needed, and it's happening a lot, but we got to continue working at it to make progress. So thank you all for joining us.
Good morning, everyone. As said, we have a great program this morning. We're going to have to move along very quickly to fit everything in. So what we're going to do is start with two presentations. Ajay Chhibber who is a visiting scholar from the Institute for International Economic Policy, will present the findings of his paper about assessing how the agenda of Addis Ababa has progressed. And then we have Channell from Citi, who's the head of social and responsible investment, who's developed a bit of a framework about having a look at how to invest in SDGs. From there, we'll invite the panel up, and as said, we have representatives from both the public and private sector to give their perspectives on financing SDGs. So without further ado, Ajay, if you want to podium. Thank you.
Thank you, Peter. Good morning, everybody. I'm not a morning person, but I'm glad to see so many people who are. I am technologically challenged as well. While this is coming on, let me just say, this paper was written while I was at IIEP a few years back. It was done for UNDESA, which is the UN Department of Economic and Social Affairs. And it was just when the Addis Ababa meeting took place, they wanted a paper to see how we could assess progress, but also to try and build some kind of an evaluation framework. The paper goes into a lot of issues, but I will, given that I have only 5 or 7 minutes this morning, I will try and just pick up a couple of issues One is sort of, I think you'll get a sense of that when Jason presents the paper that he's got. You know, and I watched this process. I was at the UN when these SDGs were being developed. I wasn't directly involved, but you know, we had MDGs which had 8 goals and 20-some, maybe 20, 30 targets. And I thought we'd end up with 12 goals and about 50 targets. But suddenly when this whole thing finished, we ended up with 17 goals and 169 targets. And so people are sort of wondering what should we do with this, you know? I visited a small country, Nepal, in north of India, and they proudly told me, "Sir, we have prepared a report which shows how to meet 17 goals and 169 targets." And I said, "You must be out of your mind." You know? Anyway, I think one issue is sort of how do you tackle such a wide agenda? And there were 2 ideas in my paper. One was to prioritize, get countries to focus on maybe 60 must-do targets and 100 desirable targets, and the rest would be aspirational. And there are ways to do that, and probably some countries, particularly smaller African countries, should really look at that. And the other is this idea, which is picked up very well in the Citi paper, on understanding the synergies, the complementarities, the tensions between different parts of the agenda. And I think it also gives, this approach also gives a very good angle for the private sector to come in. I mean, if you think of, say, a health outcome, the health, what you do on health is actually probably the 3rd or 4th most important thing to achieve a health outcome in any country. What you do on infrastructure, what you do on education, what you do on water sanitation, what you do on urbanization probably has a bigger impact on health outcomes in many countries than actually what you do in the health sector itself. And I think also there's this idea of course, impact investing, which I'll talk a little bit about, but more probably Jason will talk about it. But you know, we don't have to struggle to look for these synergies. I mean, if the private sector comes in and puts a lot of money in big infrastructure, and government resources are being used to do the last mile connectivity, like say, big highways are financed by the rural sector, and the rural roads are being financed by the public sector, that has huge outcomes than having to worry about the fact that, oh, the private sector is only doing commercial investment. I mean, you know, so these are some of the ideas in my paper, but I don't have time to go into it, but we can talk about it. Here's a sense of, you know, given that we have now all these goals, what a typical private sector project, a large, say, commercial mining project in a developing country might have to concern itself with. Sorry for it's a little small to read there, but you know, it traces out different pathways by which different impacts or different outcomes would be affected by such a project. There would be in-migration, there would be some environmental impacts, there would be, you know, a whole slew of positive and negative things which a private sector project would have to deal with and address. But it goes a little more complicated than that, because I think in trying to achieve certain goals, there are fundamentally big policy choices that countries may have to make on the approach that they will follow. So I take one example of the goal of zero hunger, and how different types of choices that would be made on whether you take a global technology solution, a decentralized solution, etc., or you try to focus on consumption more, you would end up with quite different outcomes in how they would impact different parts of the SDG agenda. again, I don't have too much time to go into it, but I can talk about it. So it's quite complicated, this issue, and I don't want to pretend, certainly my paper doesn't pretend that it is that simple. One other thought I wanted to leave is on this area is that there is also the issue of uncertainty with climate change. And in this paper, I do provide a framework for how one would use, say, 5-yearly monitoring evaluation systems to be able to adjust, you know, the path that you're going to take, because one doesn't know exactly where things will be, say, 15 years from now or 20 years from now. And the paper does address some of this issue. So this is one caboodle of issues. The other caboodle of issues I look at is, of course, financing. I do think the terminology, which used to be financing for development, and it is still the terminology, needs to change, because when you look at the numbers, and when you bring in domestic resource mobilization, when you bring in the private sector financing into the picture, which was not the case when we were dealing with the MDGs, then I think the terminology financing for development is a bit sort of top-down, if you like, or you know, telling people what to do. It's really more if 80–90% of the resources are going to come from domestic resource mobilization, then you may as well call it financing of sustainable development rather than financing for development. And you know, I think this kind of issue is very important. Of course, for very poor countries, ODA will still make up a very large part of their financing. Now, one of the things that my paper points out is that, you know, at the lower end of the development ladder, you have a lot of concessional financing, ODA. At the upper middle income, they have access to international capital on their own. The missing middle is a large swath of countries in the lower middle income category who graduate out of low income status but don't yet have access for a variety of reasons, creditworthiness, but also their domestic institutions are not yet ready. And this is where the big problem of finance is. And if you look at NDB finance also, their net flows to these countries are very, very small. In fact, I would say they're negative. They were negative at the time I wrote this paper. I haven't checked right now. So I think there's a huge area there where underutilized instruments of finance have to be brought in. I talk about blended finance, but I also talk about guarantees and insurance, which I think has been grossly underutilized in these countries. And I think NDB guarantees have not been used very well. Policy and project guarantees have not been used. We have, of course, MIGA, which does political cover. There's some use of that. Also, I was the World Bank director for Turkey, and we did the first insurance loan for ever in the history of the World Bank. Ran into huge opposition within the institution. It is these insurance backstop arrangements, which could help lower the cost of reinsurance hugely to these countries, have not been used. We found that in those countries where we have done insurance, of course, it hugely improves enforcement, better standards, better infrastructure being built, etc. So this is one area where I think perhaps the new World Bank president could take this up as his agenda going forward as well. So I think these are some of the issues. My paper also talks about global public goods and how to finance them. And I have a proposal which may not be very popular, which is, of course, Pigouvian polluter global taxes on shipping and air travel, etc. I will leave Jason to talk more about this impact investment, but I'll leave it with the last thought that at least you should have a Hippocratic oath for private sector financing, which is, if you don't do any good, do no harm, at least, in the projects that you are financing. Thank you very much.
you very much for having me along to speak to you this morning. Just like to echo a lot of the points that Ajay made. The reason for us wanting to write this, so I run, for those of you that don't know, Citi Global Insights, and I've run Citi's sustainable and responsible investment research for a number of years now, and done literally hundreds of meetings around the world with private investors and with governments. And one of the things that we universally heard from private investors was, I'm desperate to align my investments with the UN SDGs, but there's 17 of them, as Ajay was saying, there's 169 sub-targets, they're all interlinked, they all have feedback loops, not all of them are positive, I just don't know where to start. Can you please just give us some sort of an idea? So that was really what drove the sort of the nascence of this report. So to cut a very, very long process, very short for you this morning into 5 minutes, the first thing we did was to split the goals into essentially 3 groups, which is the green, the red, and the blue. So environmental and physical, it's the economic, and the social. Now the first thing to say is all of these goals could go in at least 2, if not all 3 of those brackets. But what we tried to do was to say, where do they primarily sit, and where is the fundamental driver of success in the goal? And again, you can go into that within the report. And then what we also did was we split them into kind of cause and effect within those groups as well. So to give you an example, what we're saying is with something, if you take the environmental and physical ones at the top, like you can't do climate action. The way you do climate action is by doing affordable and clean energy and a whole host of other things. It's the same for, you can't do no poverty short of doing a helicopter drop of money, which is questionable in terms of its success. What you do is you do a lot of other things that feed into that. So you get this point about, some of them are causes and are drivers, and other ones are kind of resulting effects. And you also start to see a picture emerging that the stuff on the left-hand side, these sort of causes, are roots in for private capital. They lend themselves very, very well to private investment, whereas the stuff on the right probably lends itself more towards public policy, and it's the sort of things that that government should be focusing on. Now, it's not to say that the stuff on the left is not anything to do with governments, far from it. It's very, very important, not least in terms of putting accommodative policy structures in place to allow that private capital to flow. And that can be very much from the top level in terms of political, regulatory stability and the rule of law, right down to the individual regulatory regime on one individual infrastructure asset. So you start to see this picture emerging of who should be doing what. This is sustainability Sudoku. So what we were trying to avoid here was everybody puts the SDGs in a circle, they draw the lines between all the SDGs, and they end up with one of those marvelous spirograph things that you used to draw as a kid, where you realise that everything is linked to everything else and you're right back where you started. So this is slightly different. This is the linkages, whether they are strong or weak, and it's also directional. So the way you look at this is you read across the page. So if you take something like SDG, good health and well-being, what it says is, does good health and well-being drive those SDGs across the top? And the answer is it doesn't actually drive that many. But, so it's active going across, but it's passive coming down. So if we look at good health and well-being coming down, what that's saying is good health and well-being driven by these? And the answer is it's driven by most of them. So there is a direction of travel rather than just a linkage. You can see whether they're strong or weak linkages, you can see whether they're negative linkages as well. This is a good point that Ajay mentioned. If you take something like food and hunger, agriculture simplistically is about 20% of global emissions. So if we just grow more food and have more intensive farming, then emissions are going to go up. So there's a negative feedback loop there. So all things are not equal. So what we essentially did was took those bracketing of things there. We took the strongest linkages off of this, and we developed that, which is essentially a kind of a critical pathway method of looking at the SDGs. I'm not going to go into it now, but the pathways are color-coded as well for environmental and physical: green, blue and social, red and economic. And there's an idea of some of the industries which give you a route in. So you've essentially got the private capital stuff on the left, and you've got more of the sort of public sector stuff on the right-hand side. But you can see what drives what. And then to pick up on another point that Ajay made, was it's very, very difficult to judge these 169 targets. So what we did was we looked at it and said, right, forget about, not that they're not good, but let's forget about what the UN statistics and measures are, because a lot of them are to achieve a meaningful improvement in this or significant progress in that. But what does that actually mean? So what we did within the report, and there's a section on every individual SDG within the report, is to say, well, how would we define success? And I wanted to get it down to two numbers, one of which was a human number, so the number of people that would directly benefit if we solved it, and the other one a financial number. So what is the incremental investment that we need to make each year out to 2030 to solve it? And then, kind of long story short, what we did was we put the numbers onto the pathways. They don't all add up because not all of one goal flows into another goal, but you've typically got about $1.5 trillion up here on what we call the environmental and physical ones, about $800 billion a year down here on the social ones. The biggest single one is 2.1 trillion, which is sustainable cities and communities, partly because that includes so many of the social stuff and the physical stuff as well. And we also put the human opportunity on there as well. And again, this is the number of people that would directly benefit if we were to solve that. And then what we also did, being very carefully trying to not put a value on any lives or saying some things are more important than others, but what we were trying to do was to say, if I had $1 and I wanted to invest most impactfully, how might I do it? Now, not all these goals are equal. You could never say that having access to clean and affordable energy is more important than having enough to eat. Of course it's not, right? But so it doesn't, if you like, tell you the depth of importance of the goal, but it does give you an idea of the breadth and the size of the problem. So essentially, you divide one by the other, and what you find is that where you can have the broadest impact for the least financial investment, and the ones that really jump out are things like the little green one in the middle, which is clean water. So you could fix that, we think, globally for about 2.4 billion people. It's worth pausing just thinking about that. That's 1 in 3 of us around the world that lack access to water and clean sanitation. 2.4 billion people, and we think you could fix that for about $83 billion a year. Now that's a lot of money, but in the overall scheme of things of global GDP of about 85 trillion, it's next to nothing. And the whole point with this process, of course, is that if you then think, and this goes back to Ajay's points, if you then think about if you were to fix water, how does that then flow through into impacts on health, therefore impacts onto education, etc. So it's this point about what's the maximum impact along the chains that you can have for the least investment. And I am going to leave it there. I do have to point out that there are some disclosures. I'm not going to read them out because we'll be here for hours, but if anybody wants them, I have to mention I've got them. I can email them to you. Very much looking forward to today's discussion, and thank you very much.
Ajay, Jason, thank you very much. I think done an excellent job of setting the context for how to be thinking about SDGs and some of the challenges in how we go about financing them. So we're going to now hear from people on the front line, again, both public sector and private sector capital providers, and how they look at investing and financing the SDGs. So when I announce your name, if you come up and take a seat. First we have Denny Newbern, who's the chairman board of directors for AXA, the insurance company. We got Mahmoud, who's the senior vice president for the 2030 Development Agenda, UN Relations and Partnerships for the World Bank. You're welcome. We have Donna Wilson, who's the president of Smith Graham Company. Donna, welcome. We have Sean Jones, who's the senior deputy assistant administrator for food security for USAID. And last but not least, Tim Turner, who's the chief risk officer for African Development Bank. So I will ask the panelists, once they get all properly mic'd up, to maybe just provide some opening comments on kind of what your current focus is on financing at SDGs, and then we'll sort of try to open it up and have a much more interactive discussion. So, Denny, if you would maybe kick us off.
Yes, I had some prepared remarks, but listening to Ajay, I thought that I would say things completely different, because my prepared remarks were along on the asset side of the balance sheet of insurers. I will start with that, but insurers fundamentally are here to provide provide protection, and I believe that insurance is a key component, as you said, Ajay, of development, and this is also a focus area for us. But broadly speaking, insurers have $31 trillion in assets under management, and therefore what they do with those assets is critical for the SDGs, both negatively and positively. We can divest some from some areas and invest in other areas. On the divestment side, AXA was one of the first insurers to divest from companies most exposed to coal-related activities in 2015, and this was the year of the COP21, and that was a time when there was really a moment of recognition that the private sector would be key in the achievement of the objectives of the Paris Agreement, both by investing in divesting. We divested from coal, we divested from oil sands, we stopped insuring coal production, oil sand production, pipelines for these people, and at least 20 major insurers, mainly Europeans, have started to divest from coal since then. It's not happening yet in the US, but we hope that at some point US insurers will do the same. Green investment, on the positive side, we've committed to invest 12 billion euros in green investments by 2020, and a number of other insurers are doing that. And finally, infrastructure investments, which include green investments, is a very important area because infrastructure very much corresponds to what we're looking for, i.e. assets that are long dated, because we have liabilities that are long dated. We are not, unlike many other institutions, we are not looking for liquidity, we are very long liquidity, so we can afford to invest in non-liquid assets, and therefore infrastructure for us is a good asset class. The main constraint for us is that each investment requires capital. Unlike pension funds, we need to hold capital against each of the investments that we make. And I will come to that later during the discussion. The regulatory treatment of infrastructure investments is not adequate. It's too harsh, and this is a limitation to what we can do in that field. But in summary, this is where we stand on the asset side.
Right, thank you so much. Good morning, and apology that I missed the introductory remarks, but I got very specific questions to address on the role of the World Bank Group in dealing with the financing gaps at the country level. I'd like to refer to a recent study by our colleagues at the IMF, which they estimated the costs required to achieve the SDGs in low-income countries and middle-income countries. So roughly speaking, you need additional public finance annual basis that is no less than 4 to 5% per annum in middle-income countries, and you need more than that in low-income countries, more than 14%. And that study was only focusing in 5 areas of work as far as the SDGs are concerned: education, health, energy, transport, and water. So any kind of a good assumption that governments can do the financing their own, even if they are improving their domestic resource mobilization, which has been in the Addis agenda with very generous assumptions that countries can really do that in the short to mid-term. We don't really see that realized easily, and especially for countries that are with tax revenue less than 15% of GDP. ODA, the official development assistance, including our contribution as a development finance agency and other MDBs, cannot really do the trick, because $145 billion on average of ODA during the last few years are not enough to fill the gaps. And even if we assume, and that never happened, that all of those committed to donate 0.7% of their GNI to the least developed countries, that will add another $230 billion. But as I said, that never happened. We wish it could happen, but we don't really see the dynamics of significant change in ODA, and even if it happened again, the gap will remain. So our only hope is the consideration of the private sector and the financial sector, and we treat them differently, in getting more involved in the different areas of the SDGs. Private sector have been very much involved in infrastructure finance, in energy, in climate change-related activities. But when it comes to the social sector, education and health in particular, there is a lot to be done, not just by the private sector, but by government, to avail information, to put the opportunities for projects going forward, to de-risk when needed, to provide better transparency, and including perhaps following what we suggest as the MFD, the Maximization of Finance for Development approach, which is basically trying to encourage the private sector first by stopping any kind of crowding out activity on the part of the government, and then to start getting some sort of support for a variety of private sector participation, including PPP and other norms of involvement. At the moment, we are not really realizing significant shifts as far as the achievement of the SDGs is concerned. And while we're working hard with the UN system, with many governments, if we follow the current trajectories, we see many of the SDGs not realized, including SDG 1 and ending poverty. In Africa, we're expecting, if we continue the current way, on the current way of doing business, there will be at least 22% of Africans suffering from extreme poverty. So all of the talk about zero poverty, ending poverty by 2030, still very much aspirational, and we have around 11 years to make significant change. That is more so in countries suffering from fragility and conflict, require not just some brave entrepreneurship and good spirit of getting things done, but they would require lots of work on risk management, risk mitigation, and providing variety of support to the business sector as well as to the governments going forward. If I said that about the low-income countries, there could be better prospects based on the VNR, the voluntary national reviews submitted by countries themselves to the UN system, which are now more than 104 countries, around 104 countries submitted so far their voluntary national reviews. The middle-income countries are in a better shape, despite what was mentioned recently by the managing director of the IMF about the growth prospects. If we are getting back ourselves in a better growth path, as she suggested, we can still manage to achieve what we like to see in the case of the middle-income countries. But low-income countries, fragile and post-conflict situations, are really in critical condition as we see them today, and that requires lots of partnership, help, support between government, private sector, and the development finance agencies. Thank you.
So good morning, everyone. As was said earlier, my name is Dennis. Oh, sorry. Can you hear me now?
Yeah.
Can you hear me now? So it's not, now can you hear me? Okay. All right. Thank you very much. So good morning. My name is Donna Wilson, and I'm the president of Smith Graham Investment Advisors, which is a $6 billion African-American-owned investment firm in the United States and here in Houston, Texas. But for today's events, I am privileged to serve as the chair of the board of the National Association of Securities Professionals, or NASP for short. NASP is a 35-year-old trade organization of minorities and women who work on Wall Street. Our membership is comprised of the largest investment banks and asset management firms in the U.S., such as Citigroup, Goldman Sachs, BlackRock, Wellington, etc., as well as firms owned by minorities and women. We also have some of the largest pension fund consulting firms like Wilshire, Mercer, NEPC, but by far the largest component of our membership are our clients: public pension funds, corporate pension funds, foundations, and endowments. Now, in the U.S., the largest pool of investable capital can be found in public pension funds. And of this $10 trillion industry, over $3 trillion are active participants in NASP events. Now, we began our Africa initiatives over 5 years ago through the creation of something called the Africa Financial Summit, which is programming that happens annually at our Pension Fund Investor Services Conference. And basically, we continue the conversation that was begun back in 2014 when there was the first Africa Summit here in Washington, D.C. And so, very long story short, at our first AFS Summit, one of the participants who came was USAID. And USAID had recently formed their Office of Private Capital and Micro Enterprise. And they were interested in how private capital could be enticed to operate in what was formerly the development finance realm. Now, it's been conservatively estimated that Africa needs over $90 billion annually invested in infrastructure over the next 10 years to truly achieve its economic potential. And as we all know, the totality of development finance institutions can't meet this demand alone, which is why there's a great need to engage the private sector. So, long story short, we got some money from USAID and we formed MEDA, which is Mobilizing Institutional Investors to Develop Africa's Infrastructure. And through this partnership, we formed the NASP Africa Institutional Investor Advisory Council, which is comprised of some of the largest pension funds and insurance companies in the United States. For example, CalPERS, CalSTRS, the New York State Common Retirement Fund, the New York City Retirement System, Texas Teachers, Illinois Teachers, Chicago Teachers, the University of Chicago Endowment, and so on, are a few of the members of our council, which is 45 institutions strong. We also have several African capital pools as members, including the Government Employees Pension Fund of South Africa, the ESCOM Provident Pension Fund of South Africa, and the Nigeria Sovereign Investment Authority. And they're joined by fund managers, consultants focused on infrastructure, as well as investment bankers. Now, why is there a need to form an American initiative focused on investing in African infrastructure? Now, it's unfortunately a fact that less than 1% of U.S. pension fund dollars that are allocated globally are placed in sub-Saharan Africa. And most of those funds are invested in stocks that trade on the Johannesburg Stock Exchange. Now, here in the United States, as you know, we are in the lowest yielding interest rate environment in a generation, recent results notwithstanding. So our pension funds collectively are often underfunded and are having difficulty reaching their return targets. The resulting need for yield to accomplish the return goals for the benefit of the annuitants requires U.S. institutional investors to expand their horizons as they seek safe, risk-adjusted returns. And we at NASP believe that these returns can be found on the continent of Africa, especially if they're invested in infrastructure. And specifically, we're focused on power, water, and transportation. Now, I would submit to you that the primary reason reason why American pension dollars have not been involved in investing on the African continent is the perception of risk. The average American watching the news is fed a steady diet of poverty, disease, political instability, and corruption. Never do you see the skyline of Johannesburg, which looks a lot like New York City, or the business district of Nairobi, which rivals Chicago, or the miles and miles of middle-class suburbs in Dakar. Overall, in our media, there is a sensationalism of all that's bad and a complete underreporting of the good. So the purpose of our Nasp Advisory Council is to educate, expose, and then inspire U.S. institutional investors to invest in Africa by delineating the actual versus perceived risks. And we do that by taking them there. So thanks to our USAID funding, we've had now 3 trips to the continent. The first year, we went to Johannesburg because you have to crawl before you can walk. The second year, we went to Dakar and then back to Johannesburg. And finally, just literally on Sunday, I returned from a trip to Kenya and then also back to Johannesburg. Now, I'm pleased to report that we've had some modest success to date, and that our efforts have contributed to $820 million in investments in African infrastructure through members of our advisory council in about 2 years. So, for example, the city and county of San Francisco invested $100 million in the Denham Power Capital Fund that is now investing in power plants on the African continent. We've had the Alameda County Employees Retirement System just 2 months ago invested $30 million in a mining focused private equity firm, etc. So we're starting, we've just scratched the surface of what is possible, and our investors are again focused on investing for yield and safe risk-adjusted returns. I'll stop there for now.
Hi, good morning, everyone. Can everybody hear me? Thanks. Well, good morning, and thanks for the invitation to join you all here from IEP and from Citi. I really appreciate it. I will I was until recently in the agriculture and food security space looking after the global portfolio. And more recently, I was asked to lead a 15 agency-wide initiative across the U.S. government. So this current administration's first and only so far international economic initiative thus far called Prosper Africa, which is a trade intends to substantially increase trade and investment between the United States and Africa. In that lens, one of the areas that I've had an opportunity to work on in the past several years while I've been in Washington is an initiative led by USAID called Financing Self-Reliance. This concept of self-reliance is where USAID and other parts of the U.S. government are really looking to try to change the dynamic by which developing countries feel empowered and take on more responsibility for financing their own future, financing the things they need to invest in order to take care of their people and then meet the SDGs. As part of that financing self-reliance picture, what we did across the U.S. government is we looked at the ways by which all of us in this room, and maybe utilizing USAID or U.S. government tools as a catalyst, can change the dynamic for financing. So what that means really is that we group together under this rubric of financing self-reliance, the DRM, this domestic resource mobilization grouping that all of us talk about so often. But what we also have linked to that in our construct is looking at the public financial management. It's making sure that ministries of agriculture, finance, and health are actually synced up and prioritizing things that they need to work on in their countries. It's the domestic accountability and fiscal transparency, the anti-corruption work that so many of us are involved with, the enabling environment for private enterprise, making sure that companies can actually make money, move their money around, allocate it where it's best served to be in a specific country or region. And then lastly is the fully functioning financial markets. Some of the things that Donna talked about. How do you mobilize the billions or even trillions of dollars of available capital out there to be invested in self-reliance, or in a broader concept, the financing of SDGs. So USAID and the US government as an entity, if you will, is not starting to. We've been rethinking our role in this system for some time now. And I hope that through a lot of your relationships with USAID and our partners around the world, that you're starting to see that. We're no longer view ourselves, if you will, as kind of the center of the change paradigm. What we want to be is a supporter of those who are actively moving to change the dynamic on the ground, whether it's the private sector, whether it's a local government entity, whether it's regional bodies, whatever that might be. We want to be in a supporting role. Private sector is absolutely fundamental for that changing view of the world. And so what that means is that we are also changing our toolkit. How do we support financiers? How do we support other international intermediaries or institutions? How do you support investors? And so we have updated our toolkit. We're still using a lot of the credit guarantees. We're probably one of the larger provider of credit guarantees around the world for private entities. We are still providing technical assistance. We're also still a huge funder of kind of policy work and regulatory changes and institutional reforms that need to occur in all the developing countries. But what we're also doing is we also realize that we can't be the 100% financier of a lot of projects. So we actually are choosing to prefer to be a partner of first resort rather than a financier of first resort. So what does that mean? Well, really what we're trying to do is utilize our Rolodex better, making sure that if there's a problem that's been identified in a country, or even a private sector, a group of private sector actors have come forward and said, we really need to invest in this to have X, Y, and Z change. How can we mobilize our network of partners and organizations around the world or in that country or in that region to come to the table and actually provide their solutions as well, their tools? Maybe with a little bit of funding from us, but certainly not at the 100% level that we've grown accustomed to in recent decades. So it's about convening, it's about utilizing that Rolodex, it's about catalyzing, it's about throwing out a little bit of money maybe in order to get other actors to chip in and possibly even funding it 100%. It's about mobilizing, it's about getting all of the tools of the US government into play in order to unlock the actors, unlock the tools, unlock the resources and expertise that exist from a lot of our private partners. And then lastly is to try to utilize USAID's influence or the US government's influence to help steer a group of like-minded actors towards a path that actually can help achieve some meaningful and lasting results in that problem set that we're looking at. I think ultimately what we're looking for is, and what we're leading, we believe we're leading the way in doing, and this initiative that I'm talking about, Prosper Africa, is helping to do that, is that we're looking to change the dynamic on the continent where the donors are not driving the conversation, where in fact we're in a leadership role, but we're in a leadership role from behind. And we're in a leadership role by rolling up our sleeves and actually mobilizing the entire toolkit of the US government to support the interests and the direction of the private sector.
Okay. Thanks, Sean. Tim.
Thank you, Peter. And first of all, let me thank Peter, Citibank, and George Washington University for hosting this event. It's a pleasure to be here. First of all, let me introduce the African Development Bank very briefly. It's Africa's bank. We are supported by the African Union as the sort of the development bank for the continent, an institution with just over 80 countries, sovereign shareholders, roughly 60 years old now. We do approximately $10 billion of new financing each year across the continent. The African Development Bank is pretty much all about the SDGs. We have, like the presentation said this morning, you know, when you look at the SDGs, it's an overwhelming number of targets and different metrics. And our current president, President Adesina, has boiled that down into what we call the high fives. So 5 big areas that are the focal areas for the African Development Bank. Light up and empower Africa, feed Africa, integrate Africa, industrialize Africa, and improve the lives of Africans. When you map that into the SDGs though, basically what you find is if we could achieve the high 5 objectives, we would have achieved about 90 to 95% of the SDGs. So there's a very, very close alignment. And that high 5s is sort of the roadmap for the African Development Bank and all of our activities. I guess, well, I should have said who I am. First of all, I'm the Chief Risk Officer at the African Development Bank. So my job is to make sure that we keep the bank financially healthy. But I've also served in the capacity as the head of the private sector, the IFC equivalent at the African Development Bank for about 7 or 8 years. So I've been on the front line on the lending side and seen that. And it's given me a very interesting perspective on how the African Development Bank can actually make a difference. One of the points in the presentations earlier, talking about the Addis Ababa, the agreements there. You know, one of the cliches that came out of that was the billions to trillions, which, you know, everybody talks about billions to trillions, but very few people have gone the next step to say, well, how the hell are we ever going to do that, right? Where are we going to get the resources? And we talk about the private sector as having is the reservoir of capital to meet that the SDGs, the billions to trillions. But mechanically, what are we going to do differently to create that the catalyze that kind of investment? It's very interesting, Donna, to hear what your organizations are doing, and I think in the next round of questions we're going to talk about some specific examples and what you know, the insurance companies like AXA are doing and those vast pools of resources there. Certainly the African Development Bank is thinking exactly along those lines, and we're a frontline financier, so we're a risk taker, but we also see our role as a mobilizer. How do we mobilize institutional financing to come alongside of us? Because frankly, it's the only way we're going to even get close to the billions to trillions. If we're doing 10 billion a year, that's just literally you know, scratching the surface of the needs. Institutions like ours, as African and credible African organizations, have a tremendous amount of convening power, and we're realizing that we need to use that convening power more effectively to bring together investors to change the narrative on Africa, which, Donna, as you say, you know, the mainstream news is pretty much all negative on that, whereas, you know, when you get underneath into the data and you look at the statistics of performance of portfolios, say the IFC, ourselves, and other institutional investors that are operating on the continent, our financial performance is remarkably good. You know, loss rates that are in the order of 1 or 2%, non-performing loan rates of 4 or 5%. That is good by any international standard. And one of my mantras now in working with a group of MDBs through an organization called GEMS, the Global Emerging Markets Database, which is a collective of now almost 20 international financial institutions around risk management, where we are pooling our data. We're looking at our portfolio, our actual performance data on our loans and investment portfolios, and saying, this is information that if it was to be able to be made public in some way, could be very valuable in sort of shedding light on the true performance opportunities in the emerging markets, not just Africa, but globally in the emerging markets. And so there's a big push going on right now to provide more transparency and leverage the actual histories of our institutions. And I know, I think, Denis, you will talk about Access experience now is actually leveraging off that experience of the international financial institutions. Anyway, I look forward to coming back and talking more specifically to some of the specific deals that we've done. that we think are really cutting edge and are going to push the envelope toward being able to do that, the billions to trillions. So, thank you.
Great. Thank you, panelists. Obviously, a lot to unpack there. Obviously, a lot of challenges were identified. We had some regulatory challenges on how do you get private sector capital invested correctly, the misperception of risk, the non-commitment for ODA sort of getting to the right levels, sort of some of the capacity issues really, within the recipient countries, and how do you address that. But within all that, I'd like to sort of turn to scale, and Tim, I might just go back to you, because what I'd like to put to you is like, how do we really achieve scale? Jason and Ajay, really talked about the quantum challenge that we do face here. But I'd like Tim just maybe to introduce a little bit about room to run. Should we be taking a portfolio approach? Should we basically not be thinking about going goal by goal or asset by asset or country by country, but getting the entities like AFDB that know the regions well, to get these portfolios to sort of de-risk some of this, and basically creating those investment opportunities, or is that not going to achieve it? So I'd like to hear some responses around how do we scale? Is it a portfolio approach? And I think personally, I'm very familiar with the AFDB room to run structure, which I think was quite transformational, because in my mind it was really about first establishing the proper price for risk in Africa. I think it's still too high, but I think it went a long way in the sense of creating a diversified portfolio and basically placing it in the private sector with some proper pricing. But maybe, Tim, if you could just maybe start with just introducing again the structure, and then if I could ask the other panelists to comment on how they see scaling and sort of a portfolio approach.
Yeah, thank you, Peter. And yeah, you're absolutely right that there's the only way we're going to achieve scale is to think beyond the deal-by-deal approach. It's too resource intensive, and we just don't get the kind of scale that is needed to reach go from the billions to the trillions. Our current president certainly thinks along that lines, and he was the one that came up with this idea of what we call room to run. The African Development Bank is in a bit of an interesting situation. We have come to kind of the limits of our capital base. Our risk metrics were starting to flash yellow, if not red, with the rating agencies, and it meant that we had to recapitalize. And so we started a discussion with our shareholders, who said to us, well, actually, demonstrate first of all that you're using your capital to the maximum, and then we'll talk about more capital. So I think that the G20 was a big push on this, what they call balance sheet optimization. And the Room to Run initiative was essentially, first of all, to achieve two objectives. One is to make our capital more efficiently used, and secondly, how to catalyze private financing into what we're doing. And we did it in a number of different transactions. I'll talk about the synthetic securitization, which was completed in 2018. We essentially took a pool of $1 billion of existing loans on our portfolio, infrastructure loans, project finance, and financial institutions, corporate finance loans. And then we synthetically securitized them, put into a reference portfolio, and then sold tranches to different investors. And we sold a tranche that said that losses from 2% to roughly 17%, so a 15% tranche, was sold to a consortium of approximately 20 institutional investors, most of which were American institutional investors. Just the type that you're talking about, Donna, public pension funds, private pension funds, university endowments, et cetera, through a holding vehicle that basically took risk on our existing portfolio. So if there are losses on that portfolio, they have to make a payout to us. But in the meantime, they're earning a coupon, a return that is extremely attractive, in excess of 10%. And that transaction showed us the potential scale, because essentially we were the limiting factor. There was much more demand for the paper than we could supply. We didn't have a big enough portfolio to be able to meet the demand of the investors. And we know that Room to Run 2, when that happens, will larger scale, better pricing, as you say, Peter. There's always a first mover cost associated with that. But we found that was an interesting instrument to tap into, to find a pathway to investors that never before had even considered about the possibility of investing in Africa. I'm a Canadian, and there were the idea of some Canadian pensioner who is financing a power plant across the lagoon from us in Abidjan. It to me is very sexy, if I may say so. And both sides are it's win-win. The Africans are getting the cheap and regular power. The Canadian is getting a nice return on his pension, and that we are the conduit, the pathway to do that. And there are many other very interesting approaches to this. I think the IFC's MCPP, which is where AXA has gone through that vehicle, is an example. We also did last year a portfolio credit insurance deal where we asked the Africa Trade Insurance, which is the equivalent of MIGA, a big trade insurance agency in Africa, to cover a strip of our entire portfolio. They took a vertical strip of the portfolio, and that was placed into the reinsurance market. And by doing that, it gave us capital relief, so we could start the process all over again of investing in new loans. We've been doing a number of different approaches here, pilots, essentially to test the market, to experiment, to see what works, where's the interest in the marketplace. A point that has been raised earlier, I think, about the regulatory effects. Very, very important, because we may have great ideas, Wall Street may have great ideas on how to efficiently connect the sources of capital to the users of capital, but if the regulators and the rating agencies don't see it that way, it can often find that it's an inefficient approach. And so it's only through the kind of learning by doing that we are finding which solutions work the best, and as regulations change, different solutions will prove to be the better ones. And so we will count on institutions like Citibank to help us and guide us in the future to find more and more efficient ways of doing things. But I think we are on the cusp of a massive change in the development industry because of this push for billions to trillions. If we don't do it differently, we're never going to achieve the scale that is required. We're here in Washington right now with our governors, talking around a capital increase, and it's we're trying to demonstrate that we're doing as much as we can. But it's interesting that although there was broad agreement in Addis about the billions to trillions, it's still a tough sell to get money out of the shareholders, the sovereign shareholders, and a lot of work is still ahead of us on that. So thank you very much.
Thanks, Tim. Denny, maybe you want to pick up from kind of insurance perspective on that?
Yes. First, I'd like to come with a different hat because I'm also the chairman of the Insurance Development Forum, which brings together the insurance industry, insurance and reinsurance industry, with the World Bank and UNDP. And the Insurance Development Forum was created 3 years ago with the aim of supporting the goal of insuring 400 million people in emerging markets impacted by climate change. So the initial focus was essentially on, I would say, the insurance side of things, and we believe that there is a broader understanding now that insurance is a condition for development rather than a consequence of development, and we are focusing essentially on macro schemes covering governments and or groupings of governments like the Caribbean Insurance Facility, the African Risk Capacity Facility in Southeast Asia, but also micro-insurance schemes. But more recently, we've decided to add an investment working group to this. It is chaired by Klaus Stickler, who is one of the two co-CIOs of Allianz, and co-chaired by Andy Jobs, who is here sitting in front of the World Bank. And we believe that there is a lot to be done on the investment side jointly. I mentioned the regulatory constraints. The World Bank has done studies that show that whilst the future insurance capital standards for global insurers would have a capital charge of 12.7% for infrastructure assets, the reality is that the capital charge should be of the order of 3 to 3.2%. So there is clearly this gap. But you mentioned MCBP. Yes, we did have a very good series of conversations with IFC. I think it's concerned Allianz, AXA, Swiss Re, and Prudential UK. The MCBP was in total $1.6 billion, and it was investments that were, loan investments on the balance sheet of IFC, which were transferred to the insurance industry, with the first loss protection provided by SIDA, the Swedish aid agency. We were discussing and during the breakfast with IFC, and they believe that it could be structured more efficient, more effectively by being bigger. We agree that the demand from insurers for infrastructure assets is huge. Right now, the insurance industry invests 2.3% of its assets in infrastructure, which means roughly 600 billion out of the 30 trillion that we're talking about. And we would like to invest more, but there is not enough available projects at this point. And we would very much like the multilateral development banks to move gradually to an originate to distribute model, as the commercial banks did 20 years ago, basically, in the US, because the multilateral development banks have the expertise, they can source the projects more effectively, and we would be very good balance sheets to have those assets, and potentially working with governments that can provide first loss protection, so that we get to an investment grade position, because for insurers, the issue of the capital charge is very important, and getting some first loss protection is the way to bring a single B infrastructure loan to a triple B minus, at least, which would make that investable for us.
Maybe Donna, just to turn to you, and since your members in the association, is the portfolio approach the right thing? Is it something they understand and are comfortable with? How do you, again, face the challenges that you articulated around this?
So sure. So I was an investment banker for 30 years before I went into the asset management side. I started when I was a child. That's all the way. Got the math. But here in the United States, we have the most sophisticated and active and prolific capital markets in the world. And to me, there's like these two streams. There's the traditional development finance stream, and then there's Wall Street. And neither the twain shall meet. I mean, the terminology is different, and what I like to think our organization is doing is bridging the gap between the two. And I think that if you really want to scale, you have to do it through leverage. And so, for example, all of these DFIs out here, if you would take the totality or most of your capital and use it to de-risk and to credit enhance instruments that could trade on the capital markets, then our trillions of dollars of pension funds could really look at these securities and purchase them. So for example, in the United States, we finance infrastructure through the municipal finance capital markets, right? Well, in Africa, there's only one country that has a municipal or a sub-sovereign market, and that's South Africa. And they have 4 metros that issue debt, but it's really GEO debt, general obligation debt, that they issue really for infrastructure projects, for water. So why couldn't we do the same thing, and why couldn't we get external credit enhancement for that debt? And because our institutional investors, emerging market debt funds, insurance companies would buy the paper all day long. So there's 2 ways of doing this. There's public pension funds investing through fund managers that are then investing in actual projects, power plants, water treatment facilities, all kinds of transportation, toll roads, and things like that, railways, etc., or through the proliferation of sub-sovereign debt or municipal debt, credit enhanced by
the existing, we don't have to even reinvent the wheel. We just have to take the wheel that exists and tweak it slightly and apply it to the African context. So at our organization, we're working on a couple of things right now, very specific to that. So we just came back from Kenya last week. So the government of Kenya has formed something called the Kenyan Pension Fund Consortium, because Kenya has something like, it's called KEPFIG for short, and Kenya has something like 1,300 pension funds. A lot of them are very, very small, but the top 12 of them are part of this pension fund consortium. So they're gonna pool their assets so that they can co-invest along with US institutions in projects in Kenya. Because the New York State Common Retirement Fund is gonna be much more comfortable investing in a Kenyan power project, for example, if the local Kenyan pension funds are also invested there. Also, the government of Kenya is working on sub-sovereign or municipal capital structures that then, through our organization of emerging market debt funds, we're looking to purchase. And so USAID is also, and the World Bank too, is involved in seeing how that specifically can be credit enhanced, because nothing sharpens the mind like an actual transaction that then you can talk about. So we're really trying to move the needle kind of one transaction at a time, one pension fund into one project at a time.
Thank you. Well, before we turn to Mahmoud and Sean to sort of comment on the challenge, I think private sector participants have put out to you. I know Denny's going to have to leave shortly. Did you have any concluding remark that you would like to make? Or?
No.
You good? Okay, well, thank you for coming and joining. Mahmoud, do you want to sort of, what do you think the World Bank can do, I think, is articulated by Denny and Donna in the sense of mobilizing the resources? Is the World Bank kind of focused on this? Is it directing the resources and changing kind of what we believe?
Right, okay. So the good reference to the billions, trillions brings back some memories on bringing all of the MDBs together with the IMF since October 2013 until July 2015. We're trying to convince each other whether we can leverage the private sector or not. And that came up from the fact that at the time we were estimating the gaps of around $3.5 to $4 trillion a year. OECD were estimating available funds at low yield with negative return of around $60 trillion at the time. So the whole thing is basically how to get this kind of money and funds encouraged and incentivized to fund the goals of the post-2015 agenda, they were called it. But there were three assumptions that the president of or the CEO of IFC had been emphasizing from the very beginning, otherwise we'll not be able to get there. First, the rule of law. With that comes governance. The second is information. The third is all of the efforts required in order to improve doing business in the countries. Otherwise, you'll find a great deal of discrepancy in response of different countries to the same tools available. Having said that, the bank was very much successful in a very challenging environment to increase its capital. Not just the capital of the IBRD, but the capital of the IFC, unprecedented increase. But that money that came from our shareholders in difficult and challenging times came with three conditions. First, that we have to do that work more with the private sector. Any kind of transaction has to have a first answer. Can we do it with and for the private sector? The second, that we're encouraged to go where nobody else is really going, especially in high-risk, fragile and post-conflict situations. Third, which is great news for those who are concerned about the position and status of women in many countries, especially in Africa, and I'm talking about the whole continent, not just in sub-Saharan Africa, that this is the third condition, that we have to work more with women entrepreneurs of all sizes, micro, small, and medium, and we have many initiatives for that. And these were basically the conditions under scrutiny and support of our board, that these are basically the kind of money that we are going to be unleashing going forward. Having said that, we're working as well in a variety of instruments to support the private sector. And during the last 2 years, you'll be happy to see more issuance of green bonds, more issuance of SDGs equity-linked bonds that we did with many banks, including banks represented here. I'm not quite sure that we did one with Citi, but that would be a good proposal. And, yeah, great, yeah, excellent. And actually, we are doing something as well on gender. We issued $1 billion Canadian dollar to support gender-related work on the SDGs. It's not just about SDG 5. And again, answering your question, we do that kind of, is it a portfolio approach on one single aspect? The beauty of the SDGs, unlike the MDGs, this kind of integrated approach in which you can invest in human capital, invest in infrastructure, including digital infrastructure, invest in resilience, and by that you can affect more than one goal at the same time. In addition to that, we have very good specific country-based kind of solutions, including the recent work that we have been doing, for instance, on Rwanda and digitalization, lots of work in PPP, especially in the preparation of the legal framework and the contractual arrangements. There are very specific work that we are doing as well in climate change, and I'm very happy that our new president yesterday surprised many of us that one of the areas that he's going to be focusing on is dealing with the challenges of climate change going forward, which is a relief for many of the people that are working in the mitigation and adaptation investments related to climate change. So I think it's more commitment from our side, but it's not about our aspirations or the billion to trillions kind of discussion. My colleague here in the back, Marcus Coriati, yeah, raise your hand there, is behind this term that I rejected for many days when he was trying to say, well, let's convince the team in the bank and the MDBs to use it. I said, well, one day some of us may regret it. We're not regretting it yet. It's basically about the endeavor of getting the leveraging right. But again, talking about Africa, what is happening in Rwanda is not exactly what's happening in Burundi. So here, we need really to consider the political economy dynamics and how can we tailor our financial solution within the context of risk and the challenge that we see in the specific circumstances we're facing.
Thank you. Sean, maybe just picking up a bit on the discussion around the synergies, the SDGs, and I think there's comments about if private sector capital can go into the more commercial, the impacts will then be felt around, and then more public capital can be put into, say, more of the social infrastructure. So from a USAID, even a Prosper Africa perspective, is there a particular focus around certain SDGs and and relating to the capacity building, focus that you have? If you want to comment on that.
Yeah, I appreciate the way that you've helped us frame this conversation, which is looking at it as a portfolio standpoint. I still think this idea of from a major donor aspect is us trying to figure out how can we be in a better position of reducing risk for our partners. And when I talked about it in my earlier comments about the way that we're changing the way that we're thinking, that's really what I'm talking about, is we shouldn't be involved unless we're actually helping to reduce the risk of our partners. And so regardless of any of the SDGs actually that we're looking at, and we are working substantially in, I don't know about all of them, most of them. In my personal experience, I've worked in electricity, agriculture, water, land, just in the past couple of years. And so bringing this kind of thinking about reducing risk just to those areas specifically, we've been doing a lot of work. So some examples. Well, first we do look at it as a portfolio, just to get back to that earlier question you had. And so when we're faced with the opportunity, think about the US government as sort of a big company, right? We are also presented with opportunities to invest. When we're confronted or faced with the idea of investing in something of 1,000 projects or 1,000 deals, if you will, well, we have to figure out, okay, so what's our comparative advantage? What are we adding value to? And then who's going to be our partner? We're doing that every single day. For example, when we work in enabling environment and policy reform work, we know we are probably one of the only there's a few actors who are working in that space. Well, we view that that's something worth investing heavily in because there's other actors that aren't in that space. But then maybe we're looking at something else. Until recently, I've been working on a deal with about 20 multinational companies where it's upwards of $1 billion to benefit 3 million smallholder farmers. There are several multinational banks, all of the big companies that you would, you kind of go to the grocery store and buy food from, they're all involved. And interestingly, the Dutch government is putting up a first loss guarantee. The US government is putting up a second loss guarantee. And that's the way that we feel, that we're actually going to unlock upwards of $3 billion just by mobilizing about $1 billion and helping 3 to 5 million smallholder farmers. That's the kind of work that we should be doing in the future. It's not doing $20 million projects in rural Senegal, as wonderful as it is and will be and should be. That's not where you're going to have the lasting systemic impact that we talked about. And lastly, just touch on that last piece, which is something that Ajay and Jason both talked about, is that systems-wide perspective. We are looking, when we choose project, when we choose things we're going to be investing in, we're looking at things that can have systemic change coming as a result of our limited investment or our partnership opportunity. We want to see that we are not involved in the next 3 to 5, 10, 20 years of projects in that sector in that country. We are looking for investment opportunities where we actually can make changes now that will allow us to disengage and focus on other things in the future. And I feel like that's actually the path to success on the SDGs. Go in, get your partnerships right, find the right types of investors, the right actors to work together, fix a problem, move on. Easier said than done, of course, or we've already been finished. But I believe that that's where our institution is heading, and we're really happy to be partners with a lot of organizations that are even in this room.
Great, thanks, Sean. If the panelists may indulge us for another 5 or 10 minutes to take a question or two from the audience, if that's okay. So maybe 2 questions would be, if you could just introduce yourself, and if you want to direct it to any of the panelists, please do.
Thank you. Good morning, Ambassador Duverne, the visiting scholar with the Institute for African Studies. We are not employed, but we are part of this event this morning. I don't know that you ask a question, but I'll start with a comment. Listening to the presentations, I see that you are skipping the most important goal, 5. Mr. Mahmoud mentioned it in passing, but I want, in that context, to ask, how do you see the financial inclusion as an enabler? And Christine Lagarde, every time she's quoted as saying, when women do better, economies do better, and this is smart economics. So I really want you to speak a bit about the financial inclusion. Thank you.
Thank you. I'll let Donna go first.
So I'll be really quick about it. So not only do we want to make sure that our U.S. public pension fund trustees, and I'm talking about now number 9, infrastructure, that's what we're focused on, but financial inclusion in the context that we want to increase the capacity of local public pension funds. We want to increase the capacity and capital markets development in the individual African countries. And then finally, we want to make sure that we include, so for example, one thing we've already done in Senegal, there's a Black African fund manager. It's called AFIG Funds. They have barely 200 million in assets under management, but they got a $20 million allocation from the Chicago Teachers Pension Fund for investing in Senegal in infrastructure. So we're trying to make sure that we are working with local institutions as well. That's one thing we're doing.
Right, I think, again, the emphasis on the role of women and financial inclusion is a point well taken. The recent FENDEX update is telling us that if you happen to be a woman in a rural area in Africa under the age of 25, you are less by every filter that I just mentioned by 10% to have access to finance. So everything that could be done in order to improve access to finance, and I've seen great deal of work using technology, mobile money, and we're part of that through a variety of projects. But there are three levels of engagement when it comes to our partnership there. First, the point I mentioned related to capital increase, that's one of the three conditions put by our board and our shareholders for the capital increase. So every project that we do has to go through what we call gender lens. It's not just about artificial engendering of figures, but basically we need to assess the impact of the role of women in society, access not just to money, access to education, and access to work. These are the three areas that they normally look at. The second one, there are a variety of projects by the IFC and by the bank to encourage more participation of women in them. That could be coming from a very small exercise that my team is doing under the notion of SDGs and her. And actually tomorrow we'll be celebrating the winners of innovative solutions at the small and micro enterprises for the role of women in sustainable development. Actually, one of them is from Tanzania, and the other is from India, the two winners. And the third, we have, of course, that big initiative that, again, our new president referred to in his article in the Financial Times, that he's going to be supporting it further, about what we call the WeFi, which is an initiative that we started 2 years at the bank to support women entrepreneurs with high-risk instruments that we are provided to deal with high risk and with innovation and with bigger scale of activities. We believe that through SDG 5 you can reach the rest of the SDGs comfortably, especially the most controversial of them related to SDG 1 on poverty and SDG 10 on inequality, which is the subject of the high-level political forum discussion in a couple of months in the UN.
Yeah, thank you. I really appreciate that the question, because if you've seen any of the press on President Adesina over the past year, you know that his #1 priority is an initiative that has been called AFAWA, which stands for Affirmative Financing for Action for Women in Africa. It's basically the bank's gender initiative. It is focusing on getting $3 billion of new financing for women-empowered businesses over the next 5 years. In fact, one of the objectives of my mission here is I'm with the head of the gender department, where one of the channels we're working on is that through an initiative of an organization called the Africa Guarantee Fund, which is an institution that African Development Bank helped to found 7 or 8 years ago, which essentially provides partial credit guarantees through African commercial banks and other non-banking financial institutions exclusively to support SMEs. And that institution has gone from nothing to 100 miles an hour in 5 years. It has a network of almost 200 financial institutions, portfolio somewhere around $1 billion, and extremely successful. I think it's now been rated, it's the second highest rated financial institution in Africa. It's a AA-. We're going to create a window, a gender window through the Africa Guarantee Fund that will focus exclusively on providing financing to women-empowered businesses, SMEs. And we're going to use all the innovative financing techniques that we've learned over the past few years, involving risk participations, first loss from donors, equity investments from donors, technical assistance from donors, the whole package to make it work. And we know that this is something that it can be very, very effective. Africa Guarantee Fund already does about 30% of its business to what we would call women-empowered businesses. And interestingly enough, we found that the success rate is even better than the rest of the general class of small to medium scale enterprises, which makes us feel that, you know, from a financials perspective, this can also be very successful, as well as the development perspective. So that, you know, AFAWA, WeFi, some of these major initiatives that the multilaterals are working on, really targeting a lot of resources around women-empowered businesses, and working with the donor community to find scale. And I think you'll see some big movements over the course of the next few years, and keep on top of that. I would also say, Donna, I'm very pleased to hear that you're supporting AFIC, because I remember Papa and Guy 7 or 8 years ago as an entrepreneur coming to the African Development Bank with his first fund, and now he's achieved the scale where he's attracting the true private sector. That's great news.
Thanks, Tim. Jordan, quick one?
Yeah, just really quick. I would only say that financial inclusion, gender inclusion really remains a core tenet of a lot of our programming. When I was listening to Tim, I mean, maybe with just changing some of the names of the initiatives and the funds, we could have said the same exact thing. I mean, we really are investing hundreds of millions, even billions of dollars a year, just focused on ensuring that women have access to financing, that they are provided some of the really key services and areas of interest that are specific to their needs as heads of household or managers of the bank accounts in their own families, frankly.
Thanks. Well, I think we're out of time. Hopefully the audience enjoyed all the insights and contributions, and hopefully are encouraged with all the initiatives going on. But I think the biggest is really the willingness, I think, to collaborate, to dialogue and communicate, to help close this gap and achieve the SDGs, hopefully within all our lifetimes. But it's left to me just to thank our panelists, so please join me in thanking our panelists.